is Justin Corns, and today I'm going to be showing you the interest rate forecast for the week of April 21st through the 25th. The opening of the week began with the stock market rising as investors felt the earnings are positive enough to reverse the weakness markets have seen in recent weeks. The S&P 500 rose for the fifth straight day, making it the longest positive streak in 2014. The longer-term securities swung lower as investors waited for the sale of $96 billion in government notes this week, which caused the yield curve to flatten. The 30-year bond yield was up half a basis point at 3.519, and the 5-year note fell at 1 basis point to 1.721%, showing small changes in the curve. Alright, on Tuesday, investors saw optimistic earning reports and positive home sales. The S&P 500 rose for the sixth straight day, and the conflict between Russia and Ukraine spurred investors to seek a haven in government securities. The U.S. Treasury Department offered $32 billion in 2-year notes to moderate demand from investors, which made the long-term Treasury prices swing higher. Due to this, long-term yields fell and the intermediate yields rose, narrowing the difference between them, which flattened the curve. The flatter yield curve foreshadows lower economic activity. The 10-year note fell half a basis point to 2.17, while the 30-year bond yield fell 3 basis points, and the 5-year note yield rose 1.5 basis points. And on Wednesday, Treasuries had little change, with the difference between the yields for the Treasury 7 and 30-year debt at its narrowest since 2009. The spread shrank to as little as 118 basis points. The Treasury Department offered $35 billion in 5-year notes, which auctioned at a yield of 1.732% higher than where the broader market was trading at the time. These sales and a strong report in weak growth in new home sales helped Treasury prices climb higher later in that day. The 10-year yield, which falls as prices rise, was down 4 basis points. The U.S. debt strengthened on reports that Putin warned Ukraine to stop their attacks. Due to the concern about Ukraine, the 1-month Treasury bill rates reached a negative 0.005% for the first time since February of 2013. The 10-year note fell 4 basis points, the 30-year bond fell 3.5 basis points, and the 5-year yield fell 3 basis points, which lowered the yield curve. Alright, and on Treasury bonds stayed lower Thursday, following a $29 billion sale of 7-year notes that drew decent demand from investors. The higher yields lured buyers into buying the 7-year notes at 2.317%. From the sale, there was a high demand of indirect bidding, which showed a strong demand from foreign investors, mostly due to the uncertainty of the war worldwide. Bond prices were pushed lower by a report on the U.S. spending, though tensions between Russia and Ukraine boosted the demand for ultra-safe U.S. government debt. The health of the U.S. economy has been a key factor in influence the Federal Reserve's pace in withdrawing monetary stimulus. And after the Fed toned down on its monthly bond buying program, the purchases helped bond yields stay at very low levels. And on Friday, the U.S. 30-year bonds fell to their lowest in more than 9 months, sliding for a 4th straight session, as investors sought the safety of bonds after Russia unexpectedly raised their rates after the S&P downgraded the country's credit rating to prevent a weakening inflation. The gap between short and long-term interest rates, mainly the spread between the 5-year notes and the 30-year bonds, also contracted on Friday to its narrowest since October of 2009. This flattening of the yield curve shows that the market sees the U.S. economy slowing despite the peace agreement last week. Violence in the eastern part of the Ukraine and mountain Russian troop formations across the border have weighed on the demand for German bonds and in the treasuries. can see, there's been very little change, with most of the change coming in the later dates. The yield curve on the graph, it just, as you can see, it shows very little. I would say one of the bigger changes is around the 7-year, because of the high demand of the 7-year bonds. And the 10-year bond yield slightly decreased on Friday, as it was an indicator in the housing market which received bad reports throughout the week. As you can see, the 1-year Treasury rate forecast, it as well stays pretty close to the same, with some of its bigger changes coming in the 7-year, as you can see on the yield curve from the earlier graph. And around the 10-year, you still see a really far drop. Looking at the data, the rates on the 21st were higher due to the lower yield estimates from what was predicted on the 25th. It is expected that the future interest rates will move more significantly than what is depicted here, and for inflation to be more prominent. And for a conclusion of the week, we see a dull week in interest rate changes. I mean, most of the interest rates stayed the same, as well as the yield curve becoming even flatter. And interest rates are predicted to rise more in the future, but for right now they're staying low due to the concern in Russia and Ukraine. All right, that concludes my presentation today. Thank you for watching.